Welcome back to the Corporate Finance Academy. Today we are going to talk about the balance sheet. So what we're going to talk about today, we're going to go through what the balance sheet is. We're going to remind you of the accounting equation, talk through each line of the balance sheet, and we're going to talk about why we love it and what some of the limitations are. The balance sheet is one of the three main financial statements, along with the income statement and the cash flow statement. It is a snapshot of all the company's resources or assets and all of its obligations or liabilities. Sometimes you also hear this as what it owns and what it owes. So the accounting equation, if you've taken an accounting class before, you'll know that assets equal liabilities plus owner's equity. At the end of the day, a company must pay for what it owns by borrowing money or getting it from shareholders. So an owner or several owners or stockholders who injected money into the company. So it's kind of like buying a house or a car. If you're the owner, you either pay for it in cash or you go borrow money to pay for the house. And if you borrow money to pay for your house, you have an asset, which is the house you owe, but you also have a liability, which is the mortgage you have. This is just a quick example of a balance sheet from Microsoft, just to give you an idea of what it looks like when you see it. And you have your total assets equals your total liabilities and owner's equity. Here's kind of a simplified version of probably some of the most common accounts. And you won't always see these exact same accounts. You'll see most of them, but you may see others depending on what type of company you're talking about. So one of the key differences between an income statement and a balance sheet, an income statement is a summary of a company's revenue and expenses over a period of time. Whereas when you talk about a balance sheet, it's a snapshot of the assets and liabilities at one point in time. So if you think about it like your bank statement, if you went and pulled your bank balance right now, it'd be kind of like a balance sheet. It's a snapshot of how much money you have. Whereas if you looked at a bank statement for the quarter or for the month, you're going to see cash coming in that you deposit, and you're going to see cash going out. And that's more like an income statement. It's over a period of time. So starting out, you have assets. So an asset, kind of a textbook type definition here would be, it's something that you own, and the expectation is that it provides a future benefit. So it's something that you can use going forward. So something like inventory, you can eventually sell it. It's an asset. Or a piece of machinery which you can use to make more parts that you can sell. That would be an asset. So they have a value or they create a value. So somebody's either going to pay you cash or a promise from someone to pay you cash. Liabilities, legal debt or obligation from business operation. It's settled over time. The company will provide money or goods, services to settle out that. So just like if they were to borrow from a bank, they would have to provide money back to that bank. Or perhaps it's a good or service that they have to provide. So if somebody pays you ahead of time, like if you ran an airline, the customer is going to pay you, and now you have a liability to perform a service or have a flight for that person that paid you. So starting to go line by line here. First one is current assets. So these are things that convert to cash quickly. And typically the convention you'll see is that they'll go in order of liquidity from most liquid to least liquid. So cash and things similar to cash are obviously very liquid. Actual currency or a deposit or bank account that is readily available that you can draw on very quickly. Or next is accounts receivable. So this is money that is owed to you, legally owed to you, but it's just not yet paid. And many companies give terms of approximately 30 days. That's very common. So they'll give the service or the good, and then they'll expect payment within 30 days. That would be accounts receivable. And again, the customer has a legal obligation to pay. As we work down the left side here, next is inventory. So inventory are finished products ready for sale. They could also be products that are in progress of being built, or even some of the raw materials or labor that are being used to make that product. So if you think about an automotive company, a car company, you could have an asset or inventory be finished cars, so fully finished cars that are waiting sale. It could be cars that are halfway finished with about half of it assembled, or it could just be the different parts, your bumpers, your windows, your tires. All of those could be considered inventory in different states. And next you have other current assets. So that could be a ton of different things, prepaid expenses, office supplies, or a number of other things depending on the type of company that you run. Non-current assets. So these are things that do have value, but they're going to take more time to convert into currency. Often we think about maybe a year as a good time frame between current and non-current. First one here is property, plant, equipment. Often you'll hear this called fp&a. So this could be buildings, equipment, machinery, land, something big, usually higher dollar, something that has a longer life, and it's going to take time to create the value. Again, working down our list, we have long-term receivables. So this would be a payment or a loan owed to a company, but they're not going to get it for a year or more. This could be a loan, or perhaps you have a particular customer that places a big order or is in financial trouble, and you give them 18 months of financing. You give them 18-month terms before they have to pay you. Next is a goodwill or intangible. So goodwill is created when a company buys another company and they pay more for it than the fair value of the company. And if you think about this, when one company buys another, they're buying their customers, they're buying the brand, some intellectual property they might have. A startup may have some algorithm or piece of software that has very little value on the balance sheet at this point, but you pay a lot for it because you know the future value that it could create. So, if this is leaving you feeling unbalanced, yeah, I know that's a horrible finance joke, accounting joke, but if it is, leave questions in the comments. We're happy to help try to clear anything up. Okay, moving on to the liabilities. So, similar structure as assets, you're going to have current liabilities, which are obligations that are due within a year. And working down that list, you have unearned revenue. So, deferred income. And I mentioned this example earlier, but a great example is if a company receives cash before the product's delivered, like an airline. So if Delta Airlines sells a ticket, they have unearned revenue. They have a liability to the customer to provide a flight for them. Next is accounts payable. So these are obligations and payments typically due to like a supplier for a good or service. They're short-term in nature, and again, that less than a year for current versus a year or more for long-term liability. These are typically 30, 60, 90 days that you owe payment to a vendor. Now you have the current, you have current liabilities and you have current portion of long-term debt. So any current debt payable, that would be due to creditors, so short-term borrowing, that's your current piece, and then you have the current portion of long-term debt. So if you have a long-term loan, let's call it 3 years to a bank, there's going to be an element of that, a portion of it that's due within the next 12 months, and you're going to have that classified as a current liability versus a long-term. And then you have other liabilities. I don't have this shown on the left over here, but there are a number of things that could exist, like accrued liabilities, accrued discounts and liabilities, or AD&A, accrued discounts and allowances, progress collections, salaries, payable. Any of those could be in other liabilities. And then moving on to long-term liabilities. So these are things that are due in greater than a year time. Long-term debt owed to a bank. This could be loans to buy a building or machinery, to fund operations. Oftentimes you'll see companies that aren't going to pay cash for these buildings and the machines. They're going to get some sort of long-term debt. And then the other long-term liability here is the other bucket. So lots of things could go into this bucket as well. Employee benefits, employee pensions, income taxes that are going to be owed in the future, or some other type of long-term deferred income. Owner's equity is the next element and kind of final element of the accounting equation. So owner's equity, it's the value in the assets of a company that is still there once you deduct your liability. So it's the owner investment minus any draws the owner has taken. And then you have retained earnings. So retained earnings are profits the businesses earn for future use. So when a company has their net income in a year, there's going to be an element perhaps that they pay out to the owners or stockholders, and then there's going to be the piece of it which they keep. And that piece that they keep, rather than dividend out, is your retained earnings. Then you have common stock. Also, you'll see this labeled sometimes as capital stock or paid-in capital. But this is the amount received by the company when it issued its stock. So common or preferred stock, you can see either one of those on the balance sheet. So now we talk a little bit about why the balance sheet is useful or how it's useful. So we've talked about this on the income statement, but due to the accrual concept of accounting, if you just look at cash flows, it won't tell you the whole story. Investors, creditors, as well as the company itself is going to use the balance sheet to really dig into how the business is funded. You can see how much of the business is run via debt versus equity. You can get a little more insight into how a company manages cash, how quickly they're paying their bills, how long it takes them to sell the inventory. You get a layout of what types of assets and liabilities a company has. Are they tangible or intangible? Does the company sitting on a bunch of inventory? If they have too much inventory, as an investor or creditor, you're worried that some of that could go obsolete. You can see what the company's borrowing profile looks like. Along with the income statement, the statement of cash flows, can you understand if the company has enough cash coming in to cover their interest that they're going to owe? So then you move on to some of the limitations. So as we mentioned at the beginning, the balance sheet only covers one point in time. You're not going to see seasonality effects. So if you have a business that has a high summer season or low winter season or vice versa, you're not going to see that seasonality, or whether or not the business is more linear, and those can be very important. The balance sheet definitely relies on estimates in accrual accounting. You've got a lot of things like unearned revenue and asset balances, net of depreciation. These are estimates. And some numbers are treated as historical on the balance sheet. So if you buy an asset, or maybe more like land, a piece of land you might buy for $1 million as a company, but the area around that the company develops, and that land might be worth millions of dollars now, but you're not going to show that on your balance sheet. And sometimes valuable assets don't show their real value on the balance sheet. So this would be an example, like we mentioned before, where you have a company that has a piece of software they've developed, which is going to create an enormous amount of value a ton of sales, but it just hasn't done that yet. And you may pay a lot of money for that, but it's not going to show it on the balance sheet. Similarly, let's say you were a smaller business owner and you acquired another business that has a YouTube channel or a website which has millions and millions of people that go to it every day, tons of traffic, loyal followers. That doesn't have any balance sheet value, but it can create enormous value for the company going forward. So that's it. That's our intro to the balance sheet. So a lot of things to think about. You want to know the accounting equation. You want to understand the different line items of the balance sheet and how they work, as well as why and how the balance sheet is useful and where it has some limitations. So you can work your way around those and use other analysis and other statements. So please subscribe, like or dislike this video, leave any questions, comments, things you'd like to see future videos on. We're here to help. So thank you, and we'll see you soon.